Hey everybody, quantlabs.net. Today we're going to do a first initial cut on talking about VIX, and hopefully I'll be doing more of these in the near future, just talking about general trading, but hopefully this will be my first stab at it. But this is my view on it. I'm no expert on it. I could be wrong on some of the concepts I'm about to show you, but I'm hoping to open it up and open up a dialogue somewhere on my social media. All right, so what you're looking at is the VIX for the S&P 500 intraday for today, Friday, February 12th, 2016. Now, the VIX is fairly volatile at this point. You can see that it's been pushing over 25, going up to 80, 28 at points, which is quite high for VIX. Now, what is VIX is known as a fear gauge, and it's an aggregate of all the volatility of the S&P 500. Here's the problem with VIX. It's a barometer of the markets in the present time and in the past. You really can't use it as a way to measure where things will go in the future. We can say, yes, today, right now, the VIX is up and it's volatile. We get that. But as it stands right now, and again, it's just a barometer of the volatility in the S&P. You may have some lower volatile markets, less liquid, but sometimes things may not be interlinked as we may think, but usually they are, but sometimes they're not. In terms of using VIX as a way to measure direction of the market, in my mind is not a smart way to do it. VIX is not a forward-looking gauge, okay? Again, it's present day, present time, as well as past. Retail traders seem to fall into that mentality and use it as a way to measure risk and market direction. You can, but to be honest, you want to use implied volatility, which is more forward-looking, and you can also use implied volatility for particular assets, particular sectors via an ETF. And obviously using option chain data as another measurement as well for forward guidance, which is if you're gonna, and most people will, to measure future direction in markets or a particular asset class or an asset or whatever. But VIX is good to measure present day, where we're at today. So that's fine and good. So what I'm about to show you are two scripts that you can find in my YouTube channel. If you come under YouTube, Quant Labs, and in there you will find the playlist.
Hey there.
Look for the Python attack for new quant trading, and you'll find all these scripts I'm going to show you, specifically the technical analysis one and the stats one. This is the stats one right here, and the technical analysis is this one. Okay, so again, these are just general walkthroughs on what they do. I'm not going to go into the details of these scripts. I'm just going to show you the results of VIX, and that's it. So if you want to understand how these scripts work, go here. If you want to get a full detailed walkthrough, the source code, go to become a Quant Elite member. All right? So let's get into this. So I'm going to jump into my terminal here. So what we can do here is let's first demonstrate the stats script. So if I run my Python stats script, there's a couple of parameters that I need to set up first in my script. So helps to properly spell. Here we are. So here's my parameters. Again, I'm not going to go into it. So we're going to look at the stats of starting since April last year, and there's a reason I want to do this. All right. So if I run my Python stats script, okay. What we're going to get here is the histogram of all the returns of the VIX. When I say returns, I'm really meaning differentiating between the percent movements between each day since the start of, was it April 4th, 2015. You can see it's not quite a bell curve, but it's not too extreme either. The bulk of it's fairly high, but it's these fat tails that you want to be aware of. You don't want to be on the negative side of the fat tails, the left fat tails, but if you're on the right fat tails, those are returns of upward direction and extreme upward direction. If you can calculate those using VIX and using the VIX ETFs or any ETFs related around it, you can pretty well make a boatload of money. Now, there's ways to do it. I'm not here going to show you it, but it can be done. And in this volatile market where we're at today, being, as you can see here, Friday, February 12th, 2016, it's a volatile time, and I'm going to show you that. All right, so one of the things, let me just close the right window. Thank you. All right, so this script will also generate a file. So if I load that file up, the VIX stats, not that one, TXT. Okay, now this needs to get properly fixed up. Lots of bugs in it. But what we want to look at are the number of positives and the number of negative returns and the number of positive returns. As you can see, since April last year, there's obviously a lot more negatives. But if it was one way or another, the volatility would be more negative or more positive. But these are the frequencies of your negatives and positives, okay? And these are your highs and lows as well, okay? And here's your standard deviation as well, and the mean as well. Okay. Now, knowing that, if I go into edit this stats script, and do the same thing, but only do it for this year starting January 1st, 2016, and change the date starting again. Let's say January 1st, 2016 to today. So we're looking at very close to 6 weeks of data. Okay, so if I run the stats script again, you'll get a better idea of how things work. These things are not so extreme, but they are somewhat extreme, more on the negative on the left fat tail, which means there's a lot of negative, like extreme negative volatility swings on the downside. So you want to stay away from those. Again, if you know how to short those, you can make a ton of money. But again, I'm not going to show you that, but there's ways to do it. All right, so that's the statistics. Now, if you want to still look at the file that's generated, a text file, this one, again, you'll see things are pretty well split, so it's truly volatile when you get an even number of positives and negative swings. And the frequency is pretty close to even. So that tells me since the beginning of the year, if you entered in the market just betting on anywhere in the S&P 500, you're really not getting a lot of return because you're just flatlining. Like you put money into the market, maybe the next day because the volatility is so extreme, you may lose, or the other way around. So it's a range-bound market. Or unless you're going to short, as I said, the VIX, and you know exactly when to do it, you can make a ton of dough. All right, so that's the stats on the VIX. So let's check out the technicals. Now I've got another script here called technicals, go figure. And what this does, I'm just going to set up the date, the start date. So we're going to do it since April 2015, and you're going to see exactly some very interesting things that happened since last year in August when China started depegging from the US dollar, and you'll see what happened to the markets. So if I run this technicals Python script, here's where it gets very interesting. The RSI seems to be kind of exact. You can see here in August, probably mid-August at some point, that the VIX just went through the roof over 50, and it dropped off. But you can also see her in this range, and it's exactly what happened. Is that it oversold our usual on our usual RSI of 70 bound, the upper parameter, it dropped down. Okay, and that's very good to know, because you can see what happened on the MACD and the moving averages. So in this instance, once it peaked and you got that oversell signal, hey, maybe the markets are turning. So that's a good sign. Now I could probably roll it back to probably better. Now I love doing this kind of analysis because you get to tell a lot of stories here. Oh, we didn't want to do that. What we want to do here is change our start date again. Now I'm going to go back to, let's say, the turmoil started around August 2007, let's say. So we'll put this at August 8th. August 8th, 2007, we'll see. And then things started to pick up. Well, let's just see what happens when we just do it from 2007. Let's see what happened to the VIX. Okay. So historically, if I run the script, what does it generate for me? Oh, this is very interesting again. So historically, you can see here, here's our VIX. You can see it just went through the roof here in 2007. I'm going to have to break this period down. So we're looking at, let's say, I'm going to say June 2008, and we'll do it up until about this period here. But when you look at the patterns here comparatively between 08 and present day, there's really no pattern to it. But the RSI seems to be working quite nicely. Because check it out. Here on the upper bound, the RSI of 70, it did hit the upper bound of 70, but over time it took probably a month for it to settle down, and it just dropped off. So you knew that the market may be turning back into an upward momentum. As you can see, as the VIX started to settle down, and about here is when things started to get rocking and rolling for the next bull run, just before the end of 2009, let's say. I think it was like March 2010, but it did spike. But the nice thing is it didn't really, and this is probably the temper tantrum that we keep hearing about, but you can see that the RSI is working very classically in the markets do settle down, at least on the VIX side. And yeah, as I showed you earlier in the period starting April last year. So historically, the RSI may be a nice metric to use. Okay, no, we don't want to close that. We want to close this window. All right, so I'm going to go in and start changing the script again. So let me just check something out here. Charts, technicals, this is the one we want. So we want to probably do, I'm going to estimate June 2009 to about I'll say June. Where's my sublime? There we go. So we're going to do 2009. So just 6. And then the next period is going to stop just around, I'll estimate, June 2010. Let's analyze that. Now again, we're just eyeballing here. Take that out. Now, of course, I could build GUIs to do all this for me, but for now, I got too much on my plate. I don't mind doing this. So we said June 2010. June. No. We are doing June 2011, let's say. Okay, so we'll do those two for 2 years there. Okay, so let me just close this guy. Alright. Let's run our script again. I could set up an argument on the command so. Oh, out of range, 2011. Oh, typo.
Mm.
2011. Okay. So let me just run that again. Today is not defined. Great. I don't want to be sitting here debugging a script in this video here. So today is, I guess I have to put that as today as well, so that's fine. So I'll fix that. There we go. So this is for the exact period between June 2009 all the way up to about sometime in June 2011. So here we go again. VIX started to spike up a little bit and just hits that RSI at 70, and it just starts to decline. Again, up here in May 2011, temper tantrum, and looks like that's a nice indicator we can use on VIX for when it turns, when it hits the upper bound of the RSI. Who would think that our technical analysis can sometimes historically work, and it seems to be dead on since 2008. Okay, knowing that, that's pretty good. So that's all cool historically, but let's check out just for this year. Oh. Okay, so I gotta go back to where my script resides, and that's in charts. Okay, sublime, technicals, there we go. So we're gonna remove that, put this in, change our start date to 2016, January 1st. Something wrong there. Moving average, something failed here. It's out of bounds. Damn. Guess it's not enough data. So I guess we're going to be back to our first. I think I can start it at April. And I think we can probably go back in a circle here. So what's it bitching about now? One day I'll fix this. URL. Oh, looks like my Yahoo is cut me off. Yeah, I think, oh no, that would help to go back to last year. There we go. Okay, so we're back to where we were at the start. So again, the technicals for just an August some period, overselling in the RSI, overbought, sorry, and it turns and it settles down. So who knows what will happen. If this continues to climb, it may drop it back down, but so far it's within the margins of the 30-70 in the RSI. Very interesting. So I thought I'd do an analysis on that. Hopefully that's helpful for you, just to show you many different ways to analyze the markets. And imagine if you take out the human element, the dumb operator like myself, and be able to automate all this and the kind of things that you could play around with. And you could build an entire trading system just around this alone. It's very powerful, yet alone. There's so much more else we can do, and I've demoed it time and time again. Hopefully this will help you out, and I'll talk to you later.